the US, about Europe, about global view, including emerging markets. And I was struck by Hans Helmut's comment that potentially there's a trade-off between growth on the one hand and stability concerns on the other. And Krishna, I would be interested in your view here. Is there maybe do you notice different preferences when you look at US versus Europe? Or is it probably the same if there exists this kind of trade?
So I think that there are circumstances in which you would be willing to trade off potentially some growth or even arguably some deviation from your inflation target over a specific time frame of say 2 years in order to reduce the probability of a much worse event down the line. That seems to me to be an uncontroversial and sensible statement. However, I worry about the asymmetry of these discussions, and that's one of the points I tried to address in my remarks. There are a number of circumstances in which financial stability concerns call for more accommodation. Indeed, arguably, in the current situation in the Eurozone today, one should be willing to overshoot the inflation objective in order to ensure system stability. What I worry a bit is that the BIS-type discussions too commonly go in the one direction asymmetric route where financial stability issues are only ever raised in the context of needing to be less stimulative.
Krishna is perfectly right. See, the ECB intervened very early for precisely this reason. There were very much dysfunctional markets, not allowing for interbank activity as we used to see it, and that's when the ECB started its full allotment policy and a fixed rate, which is, in other words, endogenously determined quantitative easing, nothing else. But the idiosyncrasies of the European instruments, but it's key. By the way, heavily criticized at that time by your paper. My good friend GT wrote, the ECB is acting hyperactive. Actually, so the diagnosis was precisely used. There are conditions where you should use, as Sir Paul was writing years before, the balance sheet of the central bank as a stabilizing device. But you can go overboard. You can go in the wrong direction. I do think you could, for example, and there I'll stop, generate a perfectly stable financial system dead in the water. So, too stark, too binary alternatives. But I confess my prejudices for an economy which is growing, in other words, allowing young people to get on board. Dealing with this awful youth unemployment, which is unbearable in the European case.
If I may just very, very quickly, just to add to this, I think we've got to be careful also with the definition of financial stability, which is usually defined by its opposite, financial instability. For me, financial stability means a system that is able to effectively perform its essential economic functions, and that includes contributing to growth.
In a cost-effective way.
Al, any thoughts on financial stability, and maybe from a credit person's point of view on sovereign? So, what impact do you see from QE and the reversal of QE on credit risk?
I think I'd get back to the point Christian made earlier on. There's no trade-off between financial stability and monetary stability, and they're both directly relevant to how we see credit quality on sovereigns. The greatest threat to stability, to both types of stability in the Eurozone at the moment is a prolonged period of low growth, low inflation, disinflation. Not even because that in itself is damaging, but because it leaves it exposed to shocks, whether asset price shocks, political shocks of some sort. The Eurozone needs growth. Will QE deliver growth or support the degree of growth? I think we're sceptical it'll have a significant impact, but certainly not.
So I sense quite a bit of consensus here at the panel, so that's the point where I would like to invite the audience here to disrupt the process if possible. So please raise your hand if you want to ask questions or contribute to the discussion. We'll have a microphone here. State your name and your organization. Lady back there.
Naomi Chapman, Asian Development Bank. And this isn't a question about Asia. This is purely in the spirit of disruption. One thing I don't understand as an outsider living in Germany, I agree with the comments of the panel, but then I read the comments from the Bundesbank, and I don't understand them in the context of growth and trying to get Europe back on track. So if someone could elaborate on that from the audience or from the panel, that would be very helpful for me, because that's a different point of view than we've been hearing almost all day. Thank you.
Okay, so we need a translator here, so and Helmut, I guess you're in the best position to explain Bundesbank thinking.
It's not. So it's not Bundesbank. It's a kind of analysis which claims that we are mainly and exclusively faced to structural issues. If you put it in a very simple, smaller context, it's aggregate supply and nothing but. So there's no demand from. Demand is just by incidence, somehow, but in a non-controllable way, involved. That's Sergeant Wallace, 1973. You must laugh. So it's deeply ingrained in a certain analytical. Actually, it's a major part of the fancy, dynamic, stochastic, genuine equilibrium models, which were used until 2008. They were a major roadblock in defining sensible policies. So now they are throwing in frictions. Money, for example, didn't exist because you don't need money in a world where there's perfect information. So now throwing in credit, default. So that's the analytical position. It's structure, and it's not completely wrong. For example, if you look at the case of, let's take Spain, 16% of gross value added in 2007 in construction. This was criticized ex ante by my good friend Thomas Mayer, who said in 2006, a third of European growth is coming out of Spain, mainly out of construction. That appears to be normal. So there's a structure. There are lots of structural issues. You wouldn't like to fill that gap, or would you? Would you like to increase construction in Spain towards 20%? We had it here in Germany with Eastern Germany's construction sector going to 14. Took 10 years to reduce it to the 7. It's a bit the Lord gave us two eyes to look at demand and supply. And it's. I completely agree with Adam and others. Europe has a massive output gap. And insisting on, so I come back to your remark. You were talking, Keynes wanted us economists to be like dentists. Useful. And physicians have the obligation to do no harm. So even, and I share your view, I'm rather skeptical with regard to the impact of quantitative easing, but I would have opted for it. At least it won't do no harm. And we have to think about additional instruments which get us on track again. potential growth in Europe is begging for catastrophes in the political domain. And that's why do no harm is a policy which I do think policymakers should pursue, and quantitative easing is what the ECB should have done earlier.
Other questions? If not, maybe Krishna. Wonder whether there is a case. We discussed today a lot the demand side and focusing on QE, monetary policy, and so on. So just adding what Hans Helmut said, is there a risk that there is a misplaced non-focus on these structural and supply side issues in the kind of debate that we've had?
Oh, sure. I think one of the most unhelpful features of a lot of the debate in recent years has been this sort of cartoon-like opposition between demand-side policies and supply-side policies. You obviously need both to achieve the best available economic outcomes. And, as Peter said perfectly and very clearly earlier on, that all that's happening is that the ECB is delivering its side of the bargain through monetary accommodation, but we're not seeing structural reforms, and I would argue in the Eurozone case, institutional deepening and greater integration as well. I don't think this is just a problem of policies conducted in each individual national setting. I think it's a problem of the architecture of the system as a whole, and its ability to coordinate to high-value policy equilibria, where you have deep structural reforms and counter-cyclical fiscal policies integrated together. The reason we don't have those is because we don't have the institutions that can essentially coordinate to those kind of outcomes. The US has benefited from the fact that we began with very flexible markets and federal transfers, etc., etc. So in that context, while we certainly would have benefited from some more reform, we didn't have as much of an urgent need for it, as I think is clearly the case in the US today.
Good. So thank you very much for a very insightful